Yesterday morning, full moon and Fed day. So we had a surprise rate cut. We know all about that. Now there are two headings in here that I highlighted, which I know seem kind of like, what? We're going to hike 50 basis points and then the yields are going to spike, but that is literally, but here's the irony. It's time for a yield spike. And the other title of this section was one more high is still in play. So what's happening this morning? Now, gold and silver, that was just a weird situation yesterday. I would say I did right. Everything got hit except the dollar, which is ironical because the dollar, it was the only winner at the end of the day, but it was really weird considering the size of the cut. Big cuts depreciate the dollar. Give it time. So we basically have a situation where, yes, I warned of a bond pullback. It was due anyway, TLT at that 100 week. That would have happened regardless. We just needed a macro trigger and we got the 50 basis point cut. And sure enough, we're having a strong yield spike. And the yield spike is this kind of manifestation, many people are saying, of Fed cutting too soon and we're going to have inflation. That's not how I see it. I see it as CTA positioning and we're going to go back down to lower yields later. But for right now, we are firmly in the grips of a very strong yield spike this morning. And that is helping the bond short, which I said would be short duration. And also, of course, they kind of travel together. Yen and gold did yesterday. It worked after it didn't. In other words, gold was up 1% and then ended down 1% by the end of the day. Silver fell a whole bunch. Both of those had popped right back up this morning. Not worried too much about the gold and silver trade. It is a very strong trend long. But from a standpoint of yields, we'll go by way of the dollar. For the most part, that's exactly what happened yesterday. Yields spiked and dollar was obviously down and out and then popped right back up like a daisy. And that is what we have this morning. So we did get our decision here and some folks are outraged about it. How dare they? We don't have job weakness. In fact, jobless claims came in this morning well under expectation. So they're going in the wrong direction. And then we had banks are popping up this morning because everything is just boom. Let's not get too ahead of ourselves. We do have 2 non-farm payroll unemployment rate announcements coming up October, November, and 8 weekly jobless claims data prints between this morning, which was very, very low, and Thursday, November 7th, which is when they have their FOMC meeting, but that is also not including the one election. So we're in bounce mode and we're in yield spike mode.
This short clip is presented by Club. Club provides access to Samantha LaDuc and her team of professional macro and micro traders, analysts, and educators. Club is ideal for active traders, investors, and institutions who want Samantha's best-of-breed market timing calls across all asset classes and time frames like chase, swing, and trend. Get the trade before it happens. Sign up to Club now and get full access to daily live trading room with Samantha LaDuc, Slack trading desk with detailed analysis and trades, custom trade support when you need it, and much more. For more information, visit www.LaDucTrading.com/club.
We had a big shake and bake of dollar and gold. Looked like we were going to roll over. And then, of course, we didn't. Gold and silver both had a nice little resumption pre-market. No question about it. One more high is clearly in play with SPY and Qs breaking out and higher. So remember, I have 495 in view for that NASDAQ tag. Anyway, the one more high price targets, they're working. We didn't even come down very much. But anyway, the point is oil is also the happy trade. It's going to try and move back into this kind of 72, 73 area. We'll see if it actually gets going all the way up to 79. We'll see, one step at a time. But the point is, my 65 in crude held and my 3.675 in the 10-year, I'll show you those lines, held. And now we're moving back into 3.8. So it's early yet. We're right at the crude 70. We're approaching the 10-year 3.8. It's an if-then scenario. If we can get and stay above on both of those counts, it'll be very productive. Again, banks love cheap and steep, or steep and cheap. This is exactly why Fed did 50 basis points, in my humble opinion. Very, 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 very good for banks. So that's not yet shortable for banks. Once we come back down into inversion, that'll be the de-risking mode, especially for banks. Not until, I mean, there are of course select banks that are doing worse than others, but let's, for example, Deutsche Bank above this trend line, bullish, below this trend line, get it reversing, then let's talk. But we need to reverse yet. Citibank above this 61.67 is bullish, below is bearish, and it just turned tail on a Fed 50 basis point rate cut, which JP Morgan was the only one that called it. And Citibank is the only bank that came out and said, we're going to cut 200 basis points within the next year. They did that a few months ago. They were like calling hell. They just got a lifesaver thrown to them. Fed is helping banks. There's no doubt in my mind. Very, very hard to short banks. Cheap and steep yield curve 10 and 2, and very hard if this gets above 62, it'll run back up to 66. I still think it's a mess. It's an accident waiting to happen, but no, I would not jump in front of that personally. Much better entries after we see this weaken, because it's already, look what happened, catastrophe, right? Major reflexive bounce. This is banks getting saved, but let's see what happens at this 61.67 on a monthly. Above is bullish, below is bearish. So what is my price target for that one more high? Right here. Do you see it? And all I can do when we go into all-time highs, because I don't use valuations and price earnings and any of that. Nope, nope, nope. I use technicals when it comes to, okay, we're going to have a macro bullish trigger. We got it. We got one yesterday. That's our next wave higher. Ride it until we have reason not to, like jobless claims coming in hot. They were weak this morning. And that, by the way, we had already gapped up before jobless claims came in weak. We'd already gapped up before the Philly Fed came in with prices smoking hot, which is inflationary. Anyway, the point is, this is the best guess of next level is this 58.21. We get above that, we go up to 6,010. So let's just take it level by level. So I had this 56.70 area. That was the gap we broke very strongly. And the one that I knew we had to go fill on a daily, 56.42. But on the hourly, it was 56.58. Can't see it, but it is, hold on, it was right here. So even when we rolled over, I said, it's not a question of when, if, it's just when are we going to go back and fill these gaps? We filled the daily, but we had not filled the hourly. We got above it. We came right back in on Tuesday and then again Wednesday. And now we're hot fire flames. This is the melt up into 58.21 because folks were off sides. They didn't know how to position. I'm talking about big folks, CTAs and the like. We got a yield spike. That's beneficial. We've got jobless claims, not in our face, bearish. We've got banks recovering, cheap and steep. Come on, you got to go with this. When we get the next macro trigger bearish, it's going to likely be around 58.21. Then we'll have some digestion here, some shake and bake, probably come back down into the 10. It's one of those. Look at bonds. They hit the 100. I said, be careful. Yield spike. We come back down into 97.37. Then let's see. Same thing with the 10-year. We're going to bounce back up. We have work to do here. There's still a lot of work to do. We still have to get inside the Keltner channel. We got to get up to the 3.9. We'd have to repair the 3.9 and come back into the 4.09. We'd have to get above the 4.09, which is a massive, massive monthly breakdown. Look at this. There's no way I am risk on above 4.09. That is a gap fill. Can we go back and fill that? Yeah, we can rally until there. And then that rally is going to become undone again. So our rally right now that's in NASDAQ, the markets, period. Everything is moving higher except bonds. This is still a yield spike in play. Bonds, I think, for TLT still have 97.37 on the downside to test, and then we'll see. I still can see oil getting supported, that lovely intervention collar that Robert talks about so often. Some of this will get back and fill now because we've had such a big advance this morning that has held relatively well into the European close. Bigger picture, I'm waiting for this to get up. And what happened last time was we tagged that too. And I said, I wouldn't be surprised if we have a fake breakout fast failure. Man, did that work. Now we got a double bottom situation and it has digested. You can see it's trying, but it's got to get above this trend line. It's got to get above 2. We'll see. I'll believe it when I see it type of thing, but I've got all the reasons I've already expressed. Bullish macro trigger of a Fed cut, oil supported, dollar yen supported, They like higher yields, more inflation harvesting. The banks love cheap and steep with the 10 and 2-year disinverted. Absolutely, the Fed rate cut is very powerful, easing indicator, and they are offsides in positioning, especially for the yield spike, and the 50 basis point, even more easing. They're offsides for the chase higher. And that's exactly what they're doing right now. They're chasing calls. Anyway, I think you can trim some stuff on today's big advance, but I don't see a lot of puts coming in to monetize. Appear anyway that we have a lot of puts coming in. They're still like, what just happened?
Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.